Volkswagen is reportedly preparing to eliminate 100,000 jobs and close 4 German factories, and the story has barely made a ripple in the American press. That's not a typo. 100,000 positions at a company that just outsold Tesla in European electric vehicle sales, that moved nearly 9 million vehicles last year, and that has held the title of Europe's best-selling car brand every single year since 2005. Operating profit for 2025 collapsed by 53%. Moody's downgraded their credit rating. Shares cratered to a 16-year low, having lost almost 60% of their value since CEO Oliver Blume took over. Internal documents now describe what could become the largest restructuring in the company's 89-year existence. And yet the cars keep selling, which raises the only question that matters. If the product works, what exactly is breaking down inside this company? That is what we are going to unpack today. The real reason Volkswagen is unraveling has nothing to do with the showroom floor, and everything to do with a set of traps baked into the company decades ago that no chief executive has managed to disarm. A governance system that paralyzes decisions, labor costs that tower above every competitor on the planet, a $7 billion software debacle, and the loss of the single market that bankrolled everything else. By the time we're done, you will see exactly how a company that builds winning cars can still be tearing itself apart from the inside, and why the people running it cannot fix the problem even when they know precisely what it is. Volkswagen released its 2025 financial results in March of 2026, and the numbers landed like a gut punch. Operating profit came in at 8.9 billion euros, a 53% free fall from the prior year, which pushed the operating margin down to just 2.8%, the thinnest since 2016. Net profit dropped 44% to 6.9 billion, and gross margin slid from 18.3% to 15.9%. CFO Arno Antlitz delivered a line that should worry anyone holding VW stock. Even the restructuring adjusted margin of 4.6%, in his words, isn't sustainable over a long period of time. The company's own internal target sits between 8 and 10% by 2030, and they are not even halfway there. Moody's had already pulled the trigger months earlier, downgrading Volkswagen's credit rating from A3 to Baa1 in March of 2025, which dropped Volkswagen below both BMW and Mercedes in the eyes of bond markets. And then, on June 26th, Manager magazine broke the story that Reuters and other outlets quickly corroborated. Blume and Antlitz are drawing up plans to cut as many as 100,000 jobs worldwide and shutter 4 German production sites at Hanover, Zwickau, Emden, and Audi's Neckarsulm plant. Those 4 facilities alone employ around 45,000 people, and the 5-year capital spending plan would reportedly shrink by about 15% to just over 130 billion euros. Keep in mind that only 18 months earlier, the company had negotiated a deal to cut 35,000 positions. Management is now apparently looking at nearly triple that figure. Which brings up the one question nobody outside Germany seems to be asking. If the restructuring is this obvious, why can't the CEO simply execute it? At most global companies, the chief executive runs the show and the board provides oversight. Volkswagen operates nothing like that, and the reason traces back to a single piece of legislation from 1960 called the Volkswagen Law. 3 separate power centers share control of Volkswagen, and each one pulls in a different direction. The first belongs to the Porsche PX family. Through a holding company called Porsche SE, they own about 32% of Volkswagen's total equity, but a dual-class share structure hands them roughly 53% of the voting rights. Wolfgang Porsche and Hans Michel Piech, the family patriarchs who anchor this block, are both in their 80s with no publicly known succession plan. The second power center is the German state of Lower Saxony, where Volkswagen is headquartered. Lower Saxony holds about 12% of equity and 20% of the votes, and here is where the Volkswagen Law does its damage. Normal German corporate resolutions require 75% shareholder approval, but the Volkswagen Law raises that bar to more than 80%. That single provision turns Lower Saxony's 20% into a full blocking minority, meaning a regional government staffed by elected politicians can veto virtually any strategic decision the company tries to make. The third power center is labor. Under German codetermination law, 10 of Volkswagen's 20 supervisory board seats belong to employee representatives, with 7 elected by the workforce and 3 appointed by the IG Metall trade union. The Volkswagen Law adds another wrinkle by requiring a 2/3 board majority to establish or relocate production facilities, which on a 20-seat board means 14 votes. Combine the 10 labor seats with Lower Saxony's political appointees, and you have a bloc that can stall or kill any plan that touches a factory. What this means in practice is that Volkswagen's CEO cannot close a single plant without securing buy-in from the union, the state government, and the founding family, 3 constituencies whose priorities almost never align. The family wants shareholder returns. The state wants to protect employment, and the union wants to preserve both jobs and wages. Qatar's sovereign wealth fund holds roughly 17% of voting rights as Volkswagen's third-largest shareholder, but even their weight cannot break the deadlock. We already know what happens to a CEO who challenges this arrangement. Herbert Diess, Blume's predecessor, committed 52 billion euros to electrification and tried to drag the company into the modern era. When he privately told the board that Volkswagen carried 30,000 excess staff in Germany, the Works Council, Lower Saxony, and the family united against him. The 20-member supervisory board voted unanimously to remove him in July of 2022, which tells you everything about how reform gets treated inside this structure. Lower Saxony's minister-president has already declared that the state would not agree to any development that relies on plant closures as a supposedly simple solution. IG Metall and Works Council Chair Daniela Cavallo have drawn the same line from the labor side, and the supervisory board reportedly scheduled a discussion of the 100,000 job plan for July 9th of this year. None of that changes the math on costs, though, and those costs are where the next layer of this problem lives. $66 an hour. That is what it costs, on average, to employ a single worker in the German passenger car industry, which works out to 62 euros according to 2023 figures from the VDA, Germany's Auto Industry Association. No car-producing country on the planet pays more. France comes in at 47 euros, Italy at 33, Spain at 29, and Portugal at 20. Volkswagen's situation stands out even against that backdrop. Labor consumed 15.4% of total revenue at Volkswagen in 2023, a figure that dwarfs the roughly 10% at BMW, a similar share at Mercedes, and the 9.5% to 11% range at Stellantis. Paying 50% more of every sales dollar on labor than your closest German rivals is a structural handicap that no amount of engineering talent can offset. Stifel analyst Daniel Schwartz framed it about as bluntly as anyone could when he told reporters that Volkswagen has been market leader in Europe every year since 2005, that its cars are competitive, and that the problem is not the product, but the costs. Around 120,000 workers staff Volkswagen's German operations under the representation of Works Council Chair Daniela Cavallo. When management scrapped a job security agreement dating back to 1994 in late 2024 and floated plant closures alongside a 10% pay cut, roughly 100,000 of those workers walked off the job at 9 different plants. 70 hours of negotiations followed, the longest bargaining session in Volkswagen's history, and the deal that emerged on December 20th included more than 35,000 job cuts by 2030 through buyouts and early retirement, a capacity reduction of 734,000 units, and a suspended raise, but no forced layoffs and no factory closures. Cavallo described the outcome as a rock-solid solution. What management discovered 6 months later, though, according to reporting on the 100,000 job plan, is that 15 billion euros a year in projected savings from that deal was nowhere near enough, and labor costs were only one half of the spending crisis, because while VW was hemorrhaging cash on its German workforce, it was simultaneously pouring billions into a venture that had nothing to do with building cars. Volkswagen launched an in-house software division called CARIAD in 2020 with a staggeringly ambitious mandate: build one unified software platform to run every vehicle across every brand in the empire, from the base model Volkswagen to the Lamborghini. Some executives compared the vision to creating a second SAP. What they actually created was a financial sinkhole. Between 2022 and 2024, CARIAD burned through more than $7.5 billion in operating losses, while generating only about $3.5 billion in revenue. Total software investment by the group reached roughly 14 billion euros, and the return on that spending ranged from embarrassing to catastrophic. Launch delays rippled across the portfolio, pushing the Porsche Macan EV and the Audi Q6 e-tron back by approximately 2 years each. The unified platform originally promised for 2026 had to be torn apart and redesigned from scratch, slipping its target to 2027 or 2028. Owners of ID3, ID4, and ID5 models reported software glitches that undermined confidence in the entire electric lineup. Inside CARIAD, conditions were even worse than the numbers suggest. Former employees described the operation as a patchwork of mini-corporations, and hiring had spiraled so far out of control that 6,000 people joined in a matter of months, with insiders joking that Volkswagen recruited anyone who could carry a laptop. 17 status meetings piled up every single week, turning the division into a bureaucracy, cosplaying as a technology company. Volkswagen eventually conceded defeat. A joint venture with American EV startup Rivian went public in June of 2024 and closed at up to $5.8 billion by November, while Volkswagen simultaneously licensed software from China's XPeng for the Chinese market and reportedly began unwinding a €1.5 billion automated driving partnership with Bosch. Strip away the corporate language and the picture is stark. One of the largest industrial enterprises on the planet sank 14 billion euros into a software project, watched it fail, and then paid a California startup nearly $6 billion to come in and rescue the effort. That kind of institutional misfire would be damaging enough on its own, but it landed at the exact moment Volkswagen was losing something far harder to replace than software code. It was losing an entire country. For a quarter century, no foreign automaker owned China the way Volkswagen did. 25 consecutive years as the country's best-selling car brand created a profit engine that quietly funded operations and investments across the rest of the world. BYD dethroned Volkswagen in 2024. 1 year later, Volkswagen didn't just slip to second. It fell to third behind both BYD and Geely, with group deliveries in China dropping 8% to around 2.7 million vehicles. The financial damage compressed fast. Operating profit from Volkswagen's Chinese joint ventures plunged from 1.74 billion euros in 2024 to just 958 million in 2025, a 45% collapse in 12 months. Across all German brands, Chinese market share eroded from 26% in 2019 to 16% by 2025. Robert Sisek, Volkswagen's head of China operations, conceded that the speed of the shift was beyond imagination and acknowledged that younger Chinese customers now perceive Volkswagen as the brand for the parents. In the largest car market on Earth, Volkswagen turned into your dad's brand in less than a decade. A footnote of context: Volkswagen's combustion engine business in China still held over 22% of the gasoline segment, and a few months of early 2026 data briefly showed Volkswagen's joint ventures recapturing the overall monthly sales lead when BYD stumbled. The broader direction, though, points one way. Chinese buyers, particularly younger ones, are picking domestic brands for electric vehicles, and Volkswagen finds itself scrambling uphill on what used to be its strongest ground. Volkswagen labeled 2025 a rebuilding year in China and announced EVs co-developed with XPeng on new dedicated platforms. Reversing a generational shift in brand loyalty, though, does not happen in a single product cycle. And this is the point where every thread in the story converges. Line up the evidence and the contradiction becomes almost absurd. Volkswagen beat Tesla in European EV sales during 2025, moving 274,000 battery electric vehicles against Tesla's 236,000. The Volkswagen Group captured about 27% of Europe's entire battery electric market and delivered close to 9 million vehicles worldwide. By any product yardstick, these numbers belong to a company that is winning. What the company is trapped inside, though, is a system where costs rank as the highest in the global auto industry and remain nearly impossible to cut thanks to co-determination law and the Volkswagen Law. Where China profits are evaporating under pressure from domestic competitors, where a $7.5 billion software bet collapsed and required a startup rescue, and where the last CEO who tried to force genuine change got voted out unanimously by the board that was supposed to back him. Oliver Blume, the man who replaced Diess, appears to grasp the depth of the problem. His own words: "We are noticing that the business model that carried us for decades no longer works in this form." A Volkswagen spokesperson echoed the same sentiment in June of 2026, stating that the entire group must undergo profound change. Profound change, however, is precisely what Volkswagen's governance architecture was built to block. The market capitalization gap lays the whole situation bare. Volkswagen carried a valuation of roughly $47 to $54 billion as of mid-2026. Toyota sat at around $246 to $280 billion, BYD at about $122 to $130 billion, and Tesla at $1.4 to $1.5 trillion. Volkswagen moves 5 times the number of cars Tesla does and commands roughly 3 to 4% of Tesla's market value. Wall Street and Frankfurt are not discounting the vehicles. They are discounting everything surrounding the vehicles. Everything now hinges on what unfolds in the next few weeks. The supervisory board reportedly scheduled a session on July 9th to take up the 100,000-job restructuring proposal, a meeting that could set the trajectory of the company for the coming decade. IG Metall and Works Council Chair Daniela Cavallo have staked out an unambiguous position. Cavallo's own words: "No site will be closed, no one will be laid off for operational reasons, and changes against the will of the workforce are doomed to fail." Meanwhile, the company's 2026 guidance calls for revenue growth of 0 to 3% and an operating margin between 4 and 5.5%, a range that still falls well short of the 8 to 10% threshold management considers healthy. Dieselgate cost the company more than $33 billion, erased roughly 55 billion euros in market value, and continues to generate legal consequences. Volkswagen does not have a car problem. Volkswagen has a Volkswagen problem, and right now, no one inside the building holds the power to solve it. If this breakdown helped you see what is actually going on, hit subscribe. I cover stories like this every week, the structural forces behind the headlines that most channels never touch. Drop a comment and tell me what you think Volkswagen should do. I will see you in the next one.